Let's talk about one of the most fundamental questions in all of finance. What is a company actually worth? It's a process that looks like pure science. It's all spreadsheets, complex models, and precise calculations. But as we're about to see, it's just as much an art form. It's a discipline of structured judgment, especially when you're staring into an uncertain future.
And we're going to start with a paradox that really sits at the very heart of the financial world.
I mean, think about it. How can one investor, looking at the fundamentals, see a company as a total bargain, while another person, a trader, looking at the market, sees it as wildly overpriced? The answer isn't that one of them is just wrong. It's that they're asking completely different questions. They're operating from two totally different philosophies about where value even comes from.
So to solve this paradox, we really need to dig into these two competing schools of thought. Honestly, they are the bedrock of all financial valuation.
Okay, so on one side, you've got intrinsic valuation. This is an inward-looking approach. It asks, what is this thing worth based purely on its own merits? And on the other side, you have relative valuation. This is an outward-looking approach that asks, well, what's this thing worth compared to everything else out there?
So intrinsic valuation tries to get to a company's fundamental, true worth. And it does that by totally ignoring the day-to-day noise of the market. The best analogy is valuing an orchard, right? You wouldn't value it based on the mood of the fruit market today. No, you'd calculate the value of all the fruit that orchard will produce over its entire lifetime, and then you discount that value back to what it's worth today. It is all about the cash the asset itself can generate.
Relative valuation is the complete opposite. It basically argues that value is whatever the market says it is. This is kind of like pricing your house. You don't sit down and calculate all the future rental income. No, you just look at what similar houses on your street have sold for recently. It's a method that is 100% driven by market prices and, well, market sentiment.
And this table just lays the whole tension out perfectly. Just look at that market view row. Intrinsic valuation is market independent, which is its greatest strength, but it's also its greatest weakness. And relative valuation, it's market dependent, which is its greatest strength, but also its most dangerous flaw. They are perfect mirror images of each other, and if you rely on just one, you're left with a massive analytical blind spot.
All right, so let's start by pressure testing the so-called scientific method. That's the discount cash flow model, or DCF. It's the primary tool for intrinsic valuation.
The DCF is beautiful in theory. I mean, it's a direct measure of a company's economic engine. But in practice, it's a machine that runs entirely on assumptions. And you know the old saying, garbage in, garbage out. The apparent precision of the model can create this really dangerous illusion of certainty.
Now here's where it gets really interesting. Where does most of that certainty actually come from? So in a typical DCF, we might forecast a company's cash flows for, say, 5 or 10 years. But everything after that, for the rest of time, gets bundled into this one single number called the terminal value. And just look at that. That one number often makes up more than 3/4 of the entire company's calculated value.
So that begs a pretty big question, right? How in the world do we get this all-important number? Well, it boils down to two very subjective guesses. It's either a guess about the company's growth rate forever into the future, or it's a guess about what kind of market multiple it's going to sell for at the end of our forecast. Either way you slice it, it is a huge assumption. And the model is incredibly sensitive to these guesses. A tiny, tiny tweak to the discount rate, that's the WACC, which is really just a number meant to represent the company's risk. Or just a 0.5% change in that long-term growth rate can make the final valuation swing wildly. This sensitivity is the DCF's Achilles heel. It means the model can be easily nudged, consciously or not, to spit out pretty much any number you want it to.
Okay, so if intrinsic value is built on a pretty fragile foundation, what about relative value? Well, as we're about to see, it has its own, very different trap.
The core assumption, the entire belief system of relative valuation, is that the market, on average, knows what it's doing. But this becomes incredibly dangerous during times of market euphoria, of a bubble. Because if the entire sector is overvalued, using comparables just confirms that your company is maybe the most reasonably priced house in a neighborhood that's about to go up in flames. You're measuring with a broken yardstick.
And even the tools themselves have these little biases baked in. The classic price-to-earnings ratio, it totally ignores a company's debt and can be played with through accounting tricks. The EV to EBITDA multiple, which a lot of people think is better, has its own problem. It ignores the cash you need for capital expenditures. And for a lot of big industrial companies, that is a massive, very real cost of just staying in business. No single metric is perfect.
And look, this isn't just theory. History is absolutely littered with examples of what happens when people rely on just one of these flawed perspectives.
Let's go back to the height of the dot-com bubble. AOL, a company with insane market hype but pretty weak underlying cash flows, used its massively inflated stock to buy Time Warner. The whole valuation was based on relative market pricing, what everyone else was paying. Well, when the bubble burst, the market woke up, and the value of that combined company just collapsed by 90%. It was a catastrophic failure of confusing price with actual value.
And a more recent example? WeWork. In the private markets, it was fueled by investor momentum and these constant comparisons to high-growth tech companies, and it reached this staggering private valuation of $47 billion.
But then, the company had to file for an IPO, and the public markets, armed with a much sharper, more intrinsic view of its massive cash burn and flawed business model, just said, no way. The valuation collapsed to around $8 billion. Just a brutal, brutal collision between a market narrative and fundamental reality.
So, if both methods are so flawed on their own, what's the solution? Do we just throw our hands up? No. The answer isn't to pick one over the other. It's to use them together, to force them into a conversation with each other.
And this leads us to what is really a best practice framework. Here's how the pros do it. First, you start by building an intrinsic DCF. This anchors your analysis in the company's actual fundamentals. It forces you to write down your assumptions. Then, step 2, you use relative valuation as a sanity check. Does my fundamental value make any sense compared to what the market is paying for similar companies? And this process, this back and forth, it leads you to a defensible range of value, not a single fragile number.
And this is the ultimate goal. The most skilled analysts, they get that the point isn't just to calculate a number, it's to understand the gap between the story the fundamentals are telling you and the story the market is telling you. That gap is where opportunity, risk, and true insight are all found.
Which really just leaves us with a final thought. We start this whole process looking for a hard fact, a number, but we end up realizing that valuation isn't just an act of discovery, it's an act of judgment, a structured, disciplined way of thinking about a future that we can't possibly know for sure. And mastering that judgment, that is the true art of value.